Let's imagine that you are responsible for determining ticket prices for an airline. Many people book flights a few months or sometimes even a year in advance of their trips. Between the time of purchase and the flight date, fuel prices could skyrocket, causing the airline to lose a lot of money. In order to minimize that risk, you could use a futures contract which locks in the price of fuel at a future point in time. Regardless of what happens to the price of fuel a year from now, you will pay the price specified in your futures contract. For example, if you buy a futures contract for crude oil at $50 a barrel with delivery scheduled a year from now, and oil spikes to $80 a barrel at the time of delivery, you will still only pay $50 a barrel. Many industries rely on these types of contracts. Futures contracts exist for wheat, crude oil, coffee, copper, lumber, livestock, and a whole bunch of other commodities. You can also trade futures contracts on financial products like stock indices, government bonds, foreign currencies, and even Bitcoin. The history of futures contracts stretches all the way back to ancient Mesopotamia. The Hammurabi Code allowed individuals to negotiate a fixed price for future delivery of goods. The contract became enforceable when parties agreed to terms in the presence of a neutral eyewitness. Failure to live up to your end of the bargain would result in, notions of justice back then were based on the principle of an eye for an eye and a tooth for a tooth, so you can imagine that defaulting on your financial obligations would not end well. Today, many futures traders are not even remotely interested in taking delivery of the commodities specified in the contracts that they trade. They're just speculating on future price levels with the hopes of turning a profit. But this isn't a modern phenomenon. One of the first futures contracts in recorded history involved speculation. The father of ancient Greek philosophy, Thales of Miletus, found a way to profit from a difference in the price of a futures contract and the market price at time of settlement. Philosophy wasn't a lucrative vocation back then, surprise. So in order to make some extra cash, Thales used his knowledge of weather patterns to bet that, counter to popular opinion, the upcoming olive harvest would be massive. Thales bought up contracts to rent all the olive presses in Miletus, and since nobody else thought that the harvest would be any good, he was able to get those contracts at a relatively low price. When the olive harvest turned out to be much better than expected, presses were all of a sudden in hot demand, and Thales was able to price gouge all the olive farmers and earn himself a respectable payday. It would take another couple of millennia before the first institutional commodities exchanges would be established. In the early 1700s, contracts for rice futures were routinely, though unofficially, traded by merchants in the Dojima region of Osaka, Japan. Unofficially, because the government routinely flip-flopped regarding the legality of these contracts. The government believed speculation on rice futures could artificially inflate the price of rice. Periods of high rice prices were accompanied by riots and occasionally even led to mass starvation of the peasant class. So when rice prices were too high, the government tended to strictly enforce the prohibition on rice futures trading. On the other hand, low prices were also problematic because the samurai class, which made up the civil and military administration in feudal Japan, was compensated with rice, and low rice prices effectively meant that their salaries decreased, which was the case from 1721 to 1729, when the price of rice fell by 40%. The samurai historically had a bad habit of spending lavishly on luxury items, but when the price of rice would fall, they couldn't afford them anymore. Like all privileged elite, they wanted to have nice things anyway, so they took on debt. And when the samurai couldn't repay their debts, the government would swoop in and just cancel it, since the government favored preserving the samurai class over the financial interests of merchants. As merchants began to prosper as a class, the government couldn't continue playing that card without threatening major social upheaval. So maintaining stability in the price of rice was a long-standing concern of the shogun rulers of Japan, and eventually the government caved into pressure from the merchant class and sanctioned the establishment of a rice futures exchange in 1773. Around the same time period, futures trading became an increasingly integral part of the emerging financial markets in Europe. Futures contracts for metals were routinely traded among merchants in coffee houses and parlors as far back as the mid-1500s. Increased trading activity over time eventually led to the formation of the London Metal Exchange in 1877. On the continent, futures contracts gained some notoriety in the Netherlands during a very strange period in the country's history when speculation in tulip futures briefly led to valuations that exceeded the cost of some mansions. Yeah, there was a point in Dutch history when flower futures were actually worth more than houses. The tulip craze eventually cooled down, and a good number of overzealous Dutch speculators who YOLO'd their life savings into tulip futures lost all of their money. Their descendants became the founders of Wall Street bets. In the Western Hemisphere, Chicago became an important center for futures trading in the 1800s. Due to its strategic location in the Midwest, a region renowned for its endless fields of wheat, corn, and cow pastures, Chicago became a natural hub for transporting commodities to the rest of the United States. The Chicago Board of Trade was formed in 1848 for agricultural products and the Chicago Produce Exchange was formed in 1874 and would later become the Chicago Mercantile Exchange. The two exchanges eventually merged together in 2009, forming the world's largest futures exchange, the CME Group. So what's the benefit of trading through an exchange? Exchanges not only provide a central location where standardized contracts can be traded, they also greatly mitigate the risk that counterparties might default on their obligations. Rather than relying on the threat of doling out Mesopotamian justice, exchanges require traders to maintain funds in their accounts in order to cover potential losses. These cash margin requirements allow traders to engage with any registered participant without the need to investigate their counterparty's reliability. While the intended purpose of futures contracts is to provide market participants such as airlines with a tool to hedge against price risk, many investors engage in pure speculation. The practice of using specialized knowledge as an edge has remained the same since the days of Thales of Miletus. Investment firms today have become data science powerhouses. From analyzing satellite images in order to forecast crop yields to deploying advanced machine learning algorithms that search for patterns in price trends, professional traders leave no stones unturned in order to gain an edge in today's extremely competitive markets. Thanks for listening. I hope you learned something new. Stay curious, and I'll see you next time.